Hey guys, John Paulamy here, Actionable Intelligence. Today is Saturday, September 14th, and this is the weekly market update. The disclaimer, anything that you hear or see here is not to be taken as investment advice. I'm not a financial advisor. I cannot give you personalized financial advice. Please do your own due diligence. It's your money. It's your responsibility. Okay, so with the best economy ever, according to the current administration, we have a record amount of, well, not a record amount, but we have increasing bankruptcies relative to the last few years to this point of the year. So this is year to date through August. We have 452 bankruptcies. We had 441 bankruptcies this time last year, 236 at this time in 2022. So obviously we have the rest of the year to go. Let's see if we're going to exceed. My point being here is that high interest rates, are starting to bite, as they fully flow through the economy, the lag effect is catching up. And there's a lot of companies, we've talked about this before, that are zombie companies, right? They don't generate enough cash flow to even service their debt. And that was fine if rates are low, but when rates are high, it becomes increasingly difficult to do that. And so companies get into financial trouble and declare bankruptcy. This is not a bad thing. We should not have zombie companies. We should be trying to recycle capital. Companies come to market with products, services, they fail, they should be liquidated, and that capital will go into more productive uses. But that's not how things are anymore. We don't want to allow that cleansing. And as I've talked about before, over decades now, that dead wood has built up in the economy. So we'll see what happens here, but this is not really very positive. But, we're going ready to start another rate cutting cycle here in the U.S. One of the last countries, well, one of the last major economies to do that. And obviously, we don't forecast the future here of the economic results that are possibly going to happen. It's impossible to know. It's very complicated, but we do know that we're entering a rate cutting cycle and what the typical rate cutting cycle is. Fed's not cutting rates because, they're just doing it to be funny. Real rates are, 3+% now. And depending on what you think the inflation rate is, of course, and that's constrictive on the economy. So anyway, we'll see how this goes. We'll see if this levels out. Obviously, the rate cutting cycle won't immediately affect things because that has a lag effect too. As debts get renegotiated at lower rates, that takes time to flow through the economy also. So here's a tweet from Stephanie Pomboy. She's a pretty good commentator. She was talking about the budget deficit for August that was reported this week. Says, holy budget deficit, Batman. August deficit comes in at $90 billion ahead of estimate. Looks like we won't get the details till later, but this is ugly. QE infinity coming soon. No wonder gold is flying. And so they have it here as the budget deficit for August is $380 billion. It was estimated to be $292 billion. Well, we've talked about this before, and the Western countries are all in debt, more than they can pay back, and this is going to lead to a lot of money printing down the road and currency debasement. There's no, as I've said before, I don't see anyone on either side of the political aisle, in the U.S. at least, talking about cutting spending. Both of these presidential candidates want to spend money on different things, and nobody's talking about cutting spending. Nobody's talking about reforming anything. It's just, we're in this multicultural declining empire where everybody's grabbing what they can. And that's basically what it is. Everybody's picking the carcass. So I've talked about this enough, what I think is going to happen over the future. You're living in decline. You should read Edward I think it's Gibbon, the decline and fall of the Roman Empire. You're basically living that. So you're living history right now. You're living in a declining empire. That means more war. That means more spending. That means more picking of the bones, strip mining the middle class and working classes. And there's nothing you can do about it, evidently, because, you're not going to vote your way out of it. So this is just somebody's opinion. This is the HUI versus gold. Basically, what they're saying here is, we've talked about this before, how gold has advanced. Now it made another new high this week, touched and made a new high. I think it was over 2,600 barely. Then it pulled back. But regardless, gold stocks really haven't performed, right? And so say, I like historical comparisons as a reference point to what could possibly happen in an undervalued security. And so gold stocks need to 5x from this point to reach prior highs and valuations. And gold is already at new all-time highs. And of course, in my view, going higher. So time for catch up. So, yeah, I just want to make this point that how undervalued gold stocks are and where they need to get relative to this comparison of the HUI to the gold price. We need to go 5x in gold stocks just to get back to prior highs. And if gold moves higher, that means we have to move higher. So again, I think for this period of time going forward, I think gold stocks, gold's in a bull market. I think you're seeing more and more people starting to recognize the fact. You're seeing the cash flows. You're seeing, positive. You're seeing mergers and acquisition. So I think the recognition of gold as being where you're going to see fund flows we're getting very close to that, where it's going to be all over the place and everybody's going to be doing it. And so this was from a letter I read. I can't remember. I read so many investment hedge fund letters and stuff. I cut off the when I made the slide, forgot who to credit. But anyway, this is kind of what I've been talking about. It says the gold miners have yet to participate in gold's rise. Unlike gold, gold mines are capital assets, the values of which are dependent on future cash flows and capital inflows. Consider September 3rd, a day on which oil fell by 5.8% and the gold price was flat. That was a fantastic day for the economics of mining. Revenues were constant, and one of the major costs fell precipitously, that being energy, diesel fuel. Of course, it takes time for such changes to flow into cash flows, but the whole point of financial markets is to react to such changes immediately. Yet gold stocks got clobbered on September 3rd from adverse financial market liquidity. Just because gold stocks responded in the moment to general asset prices, however, does not mean that they are defective hedges against the coming financial chaos. We know from the 1930s and the 1970s that overall, but the shortest of time frames, gold mining shares do respond to the economics of mining. Capital does and will find value. It is already happening. Excuse me. On August 12th, Goldfields acquired a Cisco Mining at a 55% premium, which implied a price of $220 an ounce, the most expensive transaction since the 2021 froth when Kinross acquired Great Bear for $275 an ounce. And the resource wasn't even defined until post-acquisition. The difference between 2021 and now is that the gold price is trending higher, not because of the sugar rush of Fed printing COVID money, but because of major structural issues in the US dollar. The Cisco acquisition put other companies on notice that they will have to pay up for premier assets. It also removes a large development project from the market. The juniors are challenged now because of the lack of capital flowing into the junior subsector, but they are far more operationally levered than the mega projects, and capital will find them at some point. In the late 1990s, there was an analyst at Prudential Securities pounding the table on steel prices and steel mill stocks. His analysis was compelling, even as steel prices slipped from over 30% from 1998 to 2001, putting huge pressure on steel mill stocks. In 2001, the brokerage firm quietly let him go and dropped coverage of the steel universe. Steel prices promptly tripled. Nucor shares went up 9-fold. U.S. Steel shares went up 18-fold. Gold mining stocks are in a similar place as steel mill stocks were in 2001, except that the underlying commodity has already started to run. The miners will catch up. That's my view. That's the end of the discourse from this letter. That's my view also. I believe the gold price will be heading higher over time, not lower, because of all the factors we've discussed before, and that the gold mining shares are underperforming, but capital will come into them because, if they don't, then you're just going to see more acquisitions. You're going to see cash flows continue to go up at a lot of miners, and they'll just start doing what other people do that have excess cash flows, right? Hopefully pay dividends and buy back shares, pay down debt, which is accretive to equity holders. So we'll see what happens. I guess the only way I would become bearish on gold stocks is if real rates were going to go up. I think real rates have bottomed and they're going to start going down. That's positive for gold. That's one of the main drivers of gold, as I've explained many times before. Plus all of the other factors that we've discussed. Central bank buying in the global south and east is going to continue. All these other things, and I believe the gold price moves higher. Now we have basically coordinated central bank rate cutting cycle going on, Money Fest 2024, and that's going to be positive for gold. So I think the gold shares represent a tremendous opportunity. If I saw budget cuts happening, if I saw rates being held here at a high level or raised, indicating that they were really serious about getting rid of inflation, things like that. If I saw structural changes in the economy to make it more efficient, I don't see any of that. I believe in structural inflation being cemented into the economy. I talked about this a lot in the September issue of the Actionable Intelligence Alert newsletter and why I think that's going to happen. What led to 40 years of lower and lower interest rates from the highs in like 1979, 1980 to the point where we had billions of dollars trading in negative interest rates just a few years ago. And I think that the circumstances that led to that are now reversing. And so I'm not going to get into that in these videos. You'd have to subscribe and read the letter, but that's the basis of my underpinning of my investment thesis going forward. And that's inevitably going to lead me then not to the stocks that have performed well over the last few years, but more back into real and tangible assets, right? And most specifically looking for more trophy type assets that, really good, well-placed mining assets, things of this nature, not just buying all these garbage junior stocks. There are really some well-managed, good companies out there in the resource sector that are undervalued, that have tremendous assets and tremendous potential. So that's where I'm looking. So this is from 9 Point Partners. Eric Nuttall says, I have it here. Oil inventories are down, but so are prices. So this shows you the global observable oil inventories onshore and oil on water. And you see where we are right now. I mean, it's like, what's going on if oil inventories are down? But then you can read different articles. People say, well, inventories aren't the right thing to look at. So what's going on in the oil market, right? People need to understand there's a physical market, there's a financial market, right? People trade, hedge funds, institutions that never are going to take delivery of any of the oil. So there's a lot of that going on, okay? We just had this carry trade blow up not even a month ago. Maybe there's some unwinding in hedge funds there. A lot of people are net bearish, right? I'm going to show you this other chart where most of hedge funds slash their bullish bets. So this is net long positions in Brent. WTI hit record low amid demand worries. So you have, people assuming demand is, affected because of the economy there, the US entering a recession, but we've seen world demand make new all-time highs. Then we have the specter of possibly OPEC pumping more oil. We just made another record high, I think, in U.S. production. So there's all of these things that are going in. But when we have everybody on one side of the boat, when we have record low bullish bets on oil from smart money, that's not normally good. That's contrarian in my view. And there was a Smead Capital who I like listening to, William Smead and Cole Smead. They had an article. They come out every week. You can get on their email list. It's pretty good. And it basically says when everyone is bearish, maybe it's time to get bullish. And that's where I got this chart from. But anyways, a couple snippets from the article. I'll put the link to it in the show notes. We learned a long time ago that we wanted to know what smart professional investors were doing. It's always better to know who is smart rather than being smart yourself. Therefore, we've constantly kept track of insider buying, what great investors like Warren Buffett and Carlos Slim were doing, and what the most successful hedge funds were up to. A recent chart stopped us in our tracks. And this is the chart they were talking about, that there's a record low bullish bets on by hedge funds in oil. And so it goes on. And this is something I didn't realize when you talk about recessions. And they talk about here, it says in the worst, talking about demand. And they list in the article like 5 or 6 things that are concerning oil market participants around demand and supply. But one of the things I thought was striking that I had not incorporated into my thinking, and I think you should consider, is this. This is why oil demand doesn't really fall that much during a recession. It says in the worst recession of 2007 to 2009, that was, of course, the great financial crisis. So it's the worst recession since the Depression of the 30s. Gasoline consumption dropped 2%. And they go on to say, that's it. In the worst recession since the Depression, oil or gasoline consumption dropped 2%. Oil and gas are addictive legal drugs and are scarce resources. Remember, 80% of the US GDP numbers are relatively fixed. And they put in here, like, think healthcare insurance. The 20% that is variable is what gets whacked in a 3% contraction in the economy. So this is why, as people have pointed out before, that even when you have these tremendous dislocations in the market or recessions, or even when we shut the world economy down, oil prices went down because it's priced at the margin, but demand, if you shut the entire world down and oil demand only goes down 20%, that kind of should wake you up. And this is what they're talking about. Is that 80% of US GDP is relatively fixed. And so, yes, you can have slight changes at the margin, but to say, well, China's in recession or the US is in recession, and so oil demand is going to collapse, it can go down in the short term, 6 months or so, a year, but the demand is relatively fixed. It's not that variable. At the margin, it can, and that can affect prices, as we talked about before. But I think those are buying opportunities. And people say, well, here we go again. People, you should be trading these things. I'm not a trader. I believe that there's substantial growth in oil and gas is continuing to happen and will continue to happen, especially from the growing middle classes and consumer classes in the global South and East. We've seen that. Yet we haven't made sufficient investments to meet that demand. And I think that at some point, that's going to lead to a substantial rise in oil prices and a substantial revaluation in oil and gas stocks. Now, the oil stocks that I own, the prices have got whacked recently because obviously the oil price goes down. That's going to whack these stocks. But if you look at the fundamentals of the company, most of these companies have paid down their debt. I mean, they've had plenty of time to do that. They've got their production costs fairly low. And so they're not going to go out of business. They can cover their dividends. And that just gives me another bite at the apple, because I think we're in a long-term, again, if I can buy oil sands in Canada with 30, 40, 50-year assets at a cheaper price when it's getting harder and harder to find new resources around the world for oil and gas, I think that's a good bargain. And I think you end up making money long-term on an overall return. Okay. So that's just an example. So I'll put a link to the article. It's kind of an interesting article. You can take a look at it, but I agree with this wholeheartedly. So this is from Goring and Rosenzweig. Why haven't gold stocks kept pace with the gold price? This is just a snippet from the article. This talks about real rates, which I've talked about. Real interest rates says this disconnect between gold and gold equities is largely explained by interest rates and the behavior of central banks. Since 2020, real U.S. 10-year interest rates have climbed from negative 0.4% to 2.1%. And I've shown this chart. It's on longtermtrends.com. You can track it in real time, the real interest rate. The snippet goes on to say, Western investors, habituated to offloading gold in response to rising real rates, have acted predictably. From 2020 to 2024, gold ETFs shed 31 million ounces, or 25% of their holdings, as investors sold both bullion and equities. The largest gold ETF, the GDX, experienced consistent outflows amounting to nearly 20% of its assets. This is reminiscent of past cycles. Between 2012 and 2015, as real rates rose from negative 0.2% to 0.8%, gold ETFs liquidated 36 million ounces. So what I try to do, it doesn't necessarily mean what's, like you say, you look at this like in 2012, the example, 2012 to 2015, real rates only rose from negative 2% to positive 0.8%, okay? And yet the ETF liquidated 36 million ounces as people sold. So it really doesn't matter what the actual real interest rate is. It just means what's the trend. And we've seen, now that we're in Money Fest 2024, now that the Fed's going to enter a rate cutting cycle, now that we've seen the 10-year yield come down in anticipation of this, and as a recession's coming, we've seen a bottoming in real interest rates, and now it's turning back the other way. Not a bottoming, but a topping, if you will. I think the last time I looked at it was like positive 2.1%. And so you want to catch the inflection. Doesn't necessarily mean, well, if it goes from positive 2.1% to positive 1.8%, you just want to catch these trend changes, okay? If the real interest rates are going up, you want to not be in the gold market. If real interest rates are getting ready to go down, you want to be in the gold market. And like I said, with the world now in a coordinated rate cutting cycle, real interest rates are going to go down as inflation's going down also around the world. You can look this up in many countries. You can argue about what the real inflation rate is, true inflation, John Williams site. It doesn't matter. People could talk about, I'm just telling you how this market reacts. And so that's what I've always said. It's not inflation necessarily. It does at the periphery, but it's really real interest rates. The difference between the 10-year yield and the inflation rate that really drives gold prices, and then which ends up being a antecedent or precursor to either a rise or decline in the gold mining shares. So I hope I didn't confuse people too much on that, but that's what we've seen, and that's what I look for. Like I said, they have that site, long-term trends, I believe it's called .com. I've shown the charts before in the weekly emails, and even on these, you can go there and you can see if the trend is up or down. And I think we've kind of changed from like a positive real interest rate, and we're going down the other way now. And I think that's what's positive for gold prices, and will inevitably cause gold mining shares to go up. So what people don't understand is like value stocks have bottomed several years ago. This is an interesting tweet. How many investors realize the S&P 500 value carved out a bottom relative to the S&P 500 growth nearly 3 years ago? In developed markets, it was almost 4 years ago. The playbook flipped, yet few realize it. Still out there chasing 40 to 50 times earnings story stocks. Good luck. And so they show the chart here. Here's the chart that was attached to this tweet. And you can see value indexes started outperforming 3 to 4 years ago. If you can look at this chart, you see here that you have the Morgan Stanley value divided by the growth. You see it in green. It's outperforming. Same thing you see in the S&P 500 value divided by S&P 500 growth. And you can see the bottoms here. So I think we're in a period where value, and I put a lot of the things that we're interested in, that I'm interested in, tangible assets, real assets, would be in the values, broadly speaking, in the value sector. So I think that you'll do well there because, like I said, a lot of things that were in place are now reversing structurally. They're not just one-offs that are just going to last, a year or 18 months. Just broadly speaking, the bifurcation of the world economy, the deglobalization that's going on because of the geopolitical situation, that's going to lead to higher prices, higher structural inflation, higher structural costs, possibly more global conflicts, war, if you will, via proxy or direct involvement. I mean, we have a situation now developing in Ukraine where we've seen this progression from we won't give them weapons to we're giving them weapons. Now we're going to give them long-term or long-range strike capability into Russia, and this is causing the fact where the Russians have now said, well, if you do that, if you're going to give NATO created weapons, missiles to the Ukrainians to launch into Russia, who is doing the targeting? Well, the satellites are run by the Europeans and the United States. The people that are firing the missiles and operating them are contractors. They're NATO personnel. And so that's a perfect example of what I'm talking about. This escalations, war and geopolitical conflict are not good for business. And so prices go up, business goes down. This is what happens. And then you're seeing this, as I said before, one of my main things that I've talked about, which many people don't see or agree with me on, which is fine. I see the U.S. hegemon, the Anglo-American Atlantist hegemon that has been in place for a couple hundred years, if you will, or at least the last 100 years. It's fading. It's going away. And the United States is going to do everything it can to try to hold on to that. That's just the history of the world, right? Where you see one country or hegemon that is in power and slowly fades and another one takes over. And that usually there's a period of conflict during that time. And so our job is to understand that and look for what are the financial repercussions of these geopolitical events. Are they one-offs or are they structural? And if they are structural, how do we position ourselves to take advantage of this? Because we have to put food on the table. This is the business of investing. Doesn't mean I agree with it. Doesn't mean I like it. That has nothing to do with it. I have my own political views, and some of them are not consistent with the way I invest. They can't be. Now, there are some things I won't do. I've talked about that before. I don't, for example, the best performing sector in the history of the stock market is tobacco stocks. I just don't want to participate in that just because I've seen the destruction that long-term tobacco use leads to. But that's me. Everybody's, some people don't want to, everybody has to make that decision on their own. So we continue to talk about global nuclear power growth. I mean, I don't know what to say, guys. I mean, the term structure, the long-term contracts, which is what really matters, is that they continue to go up, right? We've shown that multiple times. That can be easily tracked. And, you either get it or you don't get it. I don't know. I'm not going to really say much more about it, or try not to. I guess every once in a while it flares up when I see a certain tweet that aggravates me. But here we go. Like, Vietnam eyes nuclear power to secure national energy needs. And then this is a Reuters headline from last week. It says the coal-reliant industrial hub targets raising its power generation capacity by 12 to 15% a year. Well, that's why it wants to go nuclear, because otherwise they're going to have to go coal. That's what the majority of their energy production, electricity production, is coal reliant. And if they're growing their power generation capacity by 12 to 15% a year, I mean, that's not going to be good for Vietnam. And this is why nuclear there's such a renaissance in the global East and South, because all those people want what you have here in the West, whether you like that or not, or agree with that or not, that's the truth. And there's such a gap between where they're at individually, these people economically, and where we're at. There's only, and if they try to close that gap with just using fossil fuels, well, that's going to be a problem. And so nuclear will be the solution. It will be the solution. And if you have a long-term mindset, I just don't see how you lose on this. And again, that doesn't mean that your junior resource stock with the overly optimistic CEO that has no prospects of ever building a mine. I mean, guys, 1 in 3,000 mines gets built. But that doesn't mean you just don't buy uranium itself. Even you can buy it at a discount. So I don't know. It just depends if you get it and how you play it. Just because you understand a thesis, you have to actually play it the correct way. And I don't think everybody fully understands that. So we got a new shooter at the table. This is referring to uranium. This is from a tweet. Asset managers are now investing once shunned nuclear stocks. This is a quote. It says, at BlackRock Investment Institute, a unit of BlackRock, this is one of those major companies, BlackRock, we've all heard of it. Nuclear is regarded as part of the energy mix needed to power the vast data centers being built by the technology industry, unquote. There you go. So if you've got the likes of BlackRock and these other folks coming in, then, this is what we needed to see to get us to the next level. Up until this point, we've had some smaller hedge funds, Mike Alkin's fund, Art Hyde, these guys, they have funds, but they're not they're just in the tens of millions, if that. Okay. We need the big whales to come in, the new shooters with the big bank accounts to come in and really, and if they're looking at this as nuclear to power the data centers, which they are, I'm going to show another thing here from Oracle that Larry Ellison was talking about, then they're going to look at this and say, okay, yeah, nuclear is the solution over the next decade or so. Small modular reactors, okay. And then as they talk through this and think through the risk analysis, because people do risk analysis, people that know what they're doing, well, that's great. That solves the problem. But then there's a problem with the supply chain for the fuel. And that's where I think people are going to start saying, okay, wait, we have to secure, if we're going to build all these plants to supply all these data centers that we're going to build, and fuel's a problem, that's when you see the whale money, the big money start going down. People say, well, we'll just go out and secure this directly and fund it directly. And I think, that's not something I think happens on Monday morning, but I think that's going to be part of the thinking. Why would if my goal as one of these big data companies or one of these investment firms like BlackRock is to take advantage of this compound annual growth rate of in the teens for AI and data center growth, and I know I need power to do it, it's not going to happen with solar and batteries. That's obvious. Everybody now realizes that nuclear power, and probably more in the short term, gas turbines are going to be part of the solution. Then once you start going down and doing a risk analysis, you're like, well, that's great. I can build a reactor, or I can buy a parcel of land like Amazon did next to a reactor, but what happens with the fuel for this reactor? And they start realizing that. And I think that's when you start seeing that realization hit that it's underinvested, that a lot of capital needs to come in, and we need to secure the whole supply chain for your fuel, for your reactor to supply ultimately your data centers. So they're talking now 50, 100, 500, 1 gigawatt size, 1,000 megawatts of electricity to power a data center. I mean, that's like one whole nuclear power plant. That's crazy. In 1,000, you can just make the assumption that 1,000 megawatt nuclear power plant requires approximately 500,000 pounds of uranium a year to run. And if it's a new plant, it requires 3 times that for the initial load out of the fuel. So just to load out in the first year, so in the first 5 years of a plant coming online, a new plant, you'd be talking 1.5 million plus 2 million, about 3.5 million pounds for the first 5 years of a new plant of approximately 1,000 megawatts. So they know this, and I think that you're eventually going to see public-private partnerships, the government, energy department. It's going to take a while to develop, but it will, because unless we're not going to build these data centers, or this stuff isn't really going to take off. But I don't think that's the case. I think it is going to take off, and I think that, as now that nuclear really has a lot of push behind it, it's got the right people behind it, it's got the push with the government, it's got the capital, the financing. I mean, you're leaving the launch pad with a Saturn V rocket. You're going for the ride. So, and it's going to be a multi-year ride. We've continued to develop this thesis. I don't get caught up. I don't care about I don't care about the spot price. That doesn't matter. I don't care about it. And people focus on that. People that really don't know what they're doing, I think. So here's the article. This was off of Twitter. It says Oracle on data centers AI. Basically, the quote from Larry Ellison is, "We already got the permits for 3 reactors," quote unquote. So basically, it's from this guy, Ritesh Jain. Probably read it 3 times already. A mega trend staring at your face will disrupt lots of industries. Just need cheap and reliable energy. Well, the cheapest energy long term is nuclear power, and it's probably the most reliable from a base load component. I know people get into the comments and say, well, solar plus battery storage. Guys, it's not going to happen like that. I think initially you'll have gas turbines, but then you'll eventually have to transition to nuclear, because you're going to eat up so much gas. It's going to be unbelievable. We don't have an inexhaustible supply of natural gas in the US. We have a lot, but it's not inexhaustible. We have basically, if you want to look at nuclear power, it's basically inexhaustible. That's why we're going to end up there, at least till they perfect fusion, which I don't see happening anytime in the near next couple of years. So this is Oracle's Larry Ellison sees $100 billion AI boom powered by nuclear energy. This was from Bloomberg. This is a Barron's article. It says Larry Ellison has a message for the artificial intelligence infrastructure skeptics. The current boom will last for years and not end soon. When asked on Oracle's Monday earnings conference call about the sustainability, the latest wave of AI model training infrastructure spend, the executive was optimistic. Quote, "If your horizon is over the next 5 years, maybe even the next 10 years, I wouldn't worry about it. This business is just growing larger and larger and larger. There is no slowdown or shift coming." So that's the first part, and I snipped out some of it and got to the white meat here. Oracle seems to be almost there. Ellison mentioned Oracle is currently building a 800 megawatt data center that will have, quote, acres of NVIDIA GPU clusters, unquote, that will be used to train one of the largest AI models. Further, the company is already in the design phase for a data center that will require over 1 gigawatt of electricity. That's 1,000 megawatts. So he goes on to say, this is a quote from Larry Ellison, "The location and the power place we've located," he said. "We, quote, already got the building permits for 3 nuclear reactors. These are small modular nuclear reactors to power the data center. This is how crazy it's getting," unquote. So, I mean, there it is, folks. That's Larry Ellison from Oracle. So maybe he's wrong. I know some people are saying AI is a bust. I don't think it is. I think the way to participate in this is just, I don't care who builds the data centers. I don't care what chips are used. I don't care about any of that. How I'm going to participate is in the electricity needs. And I think that I'm watching, see if the orders come in at GE Power for gas turbine plants, a resurgence in gas turbine plant building, cogeneration. And then ultimately, you end up with nuclear. He's even talking about, I mean, this is the executive of Oracle talking about they've already got the permits for 3 nuclear reactors. He's talking about small modular reactors. Okay, it's not pie in the sky, me, some blogger. This is, one of the major technology companies in the world, Oracle. And I have to say, Larry Ellison, out of all the executives, he's been around for 30 or 40 years. This guy, Oracle's been a pretty steady performer. So I think if, he gets the trend, then, it's a good chance he's got his finger on the pulse. And if he's talking about this, and BlackRock's talking about this, and the Department of Energy in the US is talking about this, I mean, I think you're in pretty good company, but we'll see. Nothing's guaranteed. Nothing's for sure. Maybe AI is a total bust. Who knows? It's worth monitoring though, but I think this is where we're heading. So then we add this to the mixture. So this week, we're having this global conflict. Back to the other part of thesis that I talked about earlier, which has helped shaping my thinking about where we should be investing over the next decade. The geopolitical conflict that we're in, where we have, the BRICS, global South and East, versus the declining Atlantic hegemon. So what do we have? It says Russia considers banning uranium exports to the West. So it says Putin instructs government to consider export restrictions on number of goods, including uranium, titanium, nickel, though, and then it goes on. It says Russian President Vladimir Putin has instructed the government to analyze the possibility of restricting exports of strategic raw materials such as uranium, nickel, titanium, and a number of others, though not to the detriment of the country's economy. Folks, you need to understand something. Okay, you talk about Kazatomprom and 38% of world uranium supply. They've already made noises about, we've already talked about their production problems. Now they came up with this idea, well, it's hard to transport it to the West. This is another made-up problem. Again, it's the fissure between the global South and East and the West. All that uranium is going to China and Russia, which just basically, both of them just basically talked about ramping up their nuclear builds. I mean, this is so obvious, it's going to happen. And if you want to continue to have conflict with these people and not, what's the upside for you to get off the investment theme? This is, I don't know if it's going to happen or not happen. This is just more fuel for the fire if it does happen. I saw one guy say, well, he's bearish on uranium because this was announced, what was it, September 11th, basically last week, and nothing happened on the spot price. Again, this is not the oil market or the copper market where that information immediately goes and then traders take advantage of it. That's not how it works. And so that just tells me that people still don't get how the uranium market works. Anyhow, what I'm trying to demonstrate here is that you have a geopolitical element, you have a geological, geology, you have a management issues in Kazatomprom, geology issues there, supply problems, supply chain for raw materials that they need production, i.e. sulfuric acid, poor management of the construction. That's just a lot of problems because mining's hard. It's not easy, even for Kazatomprom. And so then you throw on the geopolitical element, this is where you end up. And again, this goes back to, if you take all this and throw all these ingredients into a pot, to me, it means higher prices for resources as we go forward. And as the BRICS develops, it's like, why do I need to do business with the West? I'm in BRICS. My future is the global, President Putin was in Vladivostok, I think 2 weeks ago, and he gave a speech. People, I mean, these kind of like Team America cartoonish views of these other people really annoy me. I mean, these are serious people you're dealing with in serious countries, okay? Doesn't mean that they're nice people. Doesn't mean they're good people. The people in our government, many of them are not nice and good people, okay? But you should listen to what they say because they have interests and they're moving their policy forward based on their interests. Countries have interests. And so he said that he was in Vladivostok, which is in Kamchatka, which is in the Russian Far East. And he said the future for Russia is in the Far East. It's in the East. Some other commentators said, he wouldn't be surprised by, 2100 that, the capital of Russia would be Vladivostok, just because there's so much. Global East is where it's at. Again, I heard Jim Rogers make this, the famous investor, billionaire investor, former Soros partner. He retired at 38, I think, from investing. He made so much money. And he said that in 1800, the place to be was London. In 1900, the place to be was New York. And in 2000, the place to be was, Beijing or Singapore, basically Asia. And so these are long-term trends. And that doesn't mean they're like investable or actionable tomorrow, but you need to consider what's really happening. When I say the West is in decline, it's in decline. I mean, look at this nonsense debate. I mean, with these candidates and look what in Europe, what's going on. The will of the people. These people do not care about their own people. At least when you look, you may not agree with this, but at least when you look at these other people, they have the interests, maybe not of the individual person, but the overall country is in their best interest. That's not what's here in the US. You have a ruling elite managerial class that cares about its own wealth and power, and that's what they function on. And, we're going to have, whether we like it or not, we're going to have lower standards of living in the West, more government control, more attacks on free speech. You've seen it, less freedom. The things that made the West, it's kind of inverting itself on itself to become the reverse Iron Curtain. And we've seen that. And that's not good for the economy, guys. So this is what I think about. You can't just think about these cartoonish visions of things and, Team America, USA, USA. I mean, what's really going on? So this goes on. I like, this is like a new guy I've been following on X. He really got some good stuff. It says incredible numbers from McKinsey, which is a consulting firm, that demonstrate how we're now in the Asian century. Just what I talked about. I've been talking about this for 10, 20 years. It's getting obvious. Asia, talking about Asia in total, not just China, Asia. Asia now accounts for more than 50% of the world's GDP growth, 50% or more of middle-class households on a purchasing power parity basis, 50% or more of manufacturing sector value added, 50% or more of top tech company global revenue growth, patents granted, value of world trade involving Asia, 50% or more. And it's going to continue. It's not going to stop. It's going to continue growing. The future is Asia. You have to be part of that. You have to understand that if you want to create wealth going forward. That doesn't mean that the West dries up and blows away, but it's going to become less of a percentage of the overall. Again, the British Empire doesn't exist anymore. The UK didn't dry up and blow away. With the same, it doesn't account for the same level of it did 100 years ago or 50 years ago. And that's what's going to happen to the United States. The United States, I've said it before, I don't think it can survive multicultural, divided country. It's basically almost the size of a continent. It's 50 countries in a confederation, basically. And when the interests are no longer aligned, which they're not regionally, racially, politically, all these things, it's going to break apart. It's inevitable. And that it's not going to happen next week, but it is already happening. And so that's not going to be good for the S&P 500. So these are the things I look at from high level, long-term trends. We'll see if it reverses. And so where do I want to put my capital? In Asia. This is where the future is right now for the next 100 years. So we just had the tweet here. It's another person outfit I follow, resourcewars.com. What do Algeria, Austria, Belgium, Cameroon, Czech Republic, Egypt, France, Germany, Ghana, Hungary, India, Nigeria, the Netherlands, Poland, Romania, Saudi Arabia, Senegal, Serbia, Slovakia, South Africa, and Turkey all have in common? All have repatriated their gold from the US and UK. Again, guys, gold is going to be remonetized. It is being remonetized, in my view. Doesn't mean we go back to a gold standard, but it's going to play a part as this end of this debt cycle in the West culminates in something. I don't know what the mechanism will be. I don't know how it will transpire. I don't know when. But the fiat currency debt-based regime is just not going to continue. It will go on till it can't go on, and then something will have to replace it. Whether that's going to be crypto, Bitcoin's going to have a place there, I don't know. But I definitely guarantee you that 5,000 years of history leads me to believe that gold will be part of that conversation. So this was another news item and a tweet talking about the CEO of Ford, the CEO and the CFO of Ford when they went to China in 2023. I thought this was excellent. It's what I was talking about in the newsletter last month, and I've been talking about. It says, in early 2023, Farley, that's the last name of the CEO of Ford, made his first trip to China since it reopened after years of pandemic restrictions. He sat in the driver's seat of an electric SUV from Ford's long-term joint venture partner, Changan Automobile, which for years had been a middling player in China, its market share hovering around 5%. Farley, who races vintage cars and has an encyclopedic knowledge of car models, thrashed the EV around Changan's sprawling test track in central China as Ford Chief Financial Officer John Lawler rode shotgun. Afterward, the executive sat silently, stunned at the progress Changan had made. The ride was smooth and quiet, and the cabin upscale with easy-to-use technology. And here's the quote from the CFO to the CEO. Quote, Jim, this is nothing like before, Lawler told Farley after the drive. These guys are ahead of us. This is the CEO and CFO of the Ford Motor Company. This is what I've been talking about. This is why China now basically has taken over the automobile export market in the world. And this will be industry after industry. My pride is not personally hurt. We gave all this away to them. It was inevitable. 1.4 billion people, the wage arbitrage, the investments, the ability to, that doesn't mean that China's a perfect place, but this was inevitable, guys. And so how do you make money? How do we have the American people benefit from this? Okay, instead we're going to have a war with them. They don't need, I heard Bob Moriarty, who I have a lot of respect for, he runs 321 Gold. He was on an interview the day. He says, I have intelligence that says that China is going to invade Taiwan on September 22nd. Sometime between the 22nd and 26th. Why does China need to invade Taiwan? They don't need to do anything. They're just going to absorb the place, okay? Because it's going to be in Taiwan's interest to be part of China again. They're just going to wait out the U.S. There's not going to be a war. That's why you're doing all these. The U.S. is trying to make China and Russia cross all these, trying to antagonize them into doing something so they can justify some kinetic military conflict with them. Neither one of these countries has to do anything but sit there and be patient. And the West is doing itself in. And this is what's going on. This is reality. This isn't a blogger. This isn't me. This is the CEO and CFO of the Ford Motor Company. You can either believe them or you can disregard what they're saying. So that's it for this week. Thanks for the support. Again, shout out for the Actionable Intelligence Alert newsletter, $179 a year, one issue per month. It's got the model portfolio, big write-ups. I think the write-up last month was like 3,000, 4,000 words, something crazy. And, we're trying to get ahead of these trends, trying to put aside the biases or what we want, how we want the world to be. What is happening in the world in reality, whether I like it or not? And then how, once we create a what we think is happening trend-wise, then we try to apply that. What investment themes, what vehicles can we put money into to take advantage of that? That's what the Actionable Intelligence Alert newsletter is for. We've also got the free newsletter that goes out. It's kind of what articles I'm reading, what podcasts I'm listening to, some more general thoughts. Sometimes I'm able to give you some more information, but to get to the specific ideas of what we're doing, we got the paid service. We also have the Patreon if you want to experience and sample some of my writing on a specific investment idea. All of this stuff is in the show notes below. You can check that out and decide how you want to support us. You can also buy us a coffee. This is reader and listener supported endeavor, so feel free to support us any way you can. If you just like watching the videos, like these videos, comment. It helps the algorithm, and it helps us expand our listenership, readership, and allows us to attract even more people for interviews and discussion. So thanks a lot. Have a good week, and we'll talk to you next week. Thanks.